Welcome to our video on the top 5 stock market investing tips. If you're ready to improve your investment strategy, you're in the right place. Let's dive into insights that can help you navigate the market effectively and achieve your financial goals. First and foremost, setting clear financial goals is crucial before you start investing. Ask yourself what you aim to achieve, be it retirement savings, a major purchase, or long-term wealth building. This clarity will guide your investment choices and help you stay focused during market fluctuations. For instance, if your goal is retirement, a long-term strategy with a balanced portfolio might be ideal. This could include blue-chip stocks and dividend-paying companies. Alternatively, if you're seeking short-term growth, you might opt for riskier growth stocks or tech companies. Diversifying your portfolio cannot be overstated when it comes to reducing risk. By spreading investments across different asset classes, sectors, and locations, you minimize the impact of poor performance from any single asset on your portfolio. Sector diversification involves investing in industries like technology, healthcare, and finance. Geographical diversification includes international stocks, which can balance your portfolio if one region underperforms. Diversifying across asset classes like stocks, bonds, and real estate also enhances stability. Exchange-traded funds, ETFs, and mutual funds are excellent tools for quick diversification. They allow you to invest in a basket of securities, thus spreading your risk across multiple assets with a single investment. Risk management is a foundational aspect of stock market investing. Understand the risk you're comfortable with and align it with your financial goals and timeline. Effective risk management can prevent excessive losses. Assessing your risk tolerance is essential. Younger investors may take on more risk since they have time to recover from losses. Conversely, older investors might favor low-risk investments to safeguard their capital. Using stop-loss orders is a practical risk management technique. It allows you to predetermine a selling price for stocks, automatically selling them if the price drops below a certain level, thus limiting potential losses. The 1% rule is another risk management strategy. It involves limiting any single investment to a small percentage of your portfolio, preventing significant impacts from one stock's poor performance. Keep in mind that the stock market can be unpredictable. While research is crucial, maintaining a cautious approach to risk management is wise, avoiding overly aggressive strategies driven by speculation. Thorough research and staying informed are key to successful investing. Before purchasing a stock, delve into the company's fundamentals, industry trends, and competitive position. This understanding can guide strategic decisions. Evaluate financial health by studying balance sheets, income statements, and cash flow statements. These provide insights into a company's profitability, debt levels, and growth potential, crucial for making informed investment choices. Consider the company's competitive position and how it compares with peers. A strong market position in a growing industry may indicate potential for appreciation and better investment opportunities. Stay updated on broader market conditions and trends, including economic and geopolitical issues. These factors can significantly impact stock performance and influence your investment strategy. Reliable information sources include earnings reports, company releases, trusted financial news outlets, and regulatory bodies like the SEC. These can help you make well-informed decisions. Investing with a long-term perspective can significantly benefit your financial journey. The power of compounding over time can help your investments grow, even through short-term market volatility. A buy and hold strategy is effective for long-term wealth creation. It involves purchasing high-quality stocks with growth potential and holding them despite market fluctuations, a strategy endorsed by legendary investors. This approach reduces stress since you won't need to constantly monitor market movements to make frequent trades. It also leverages compounding growth, where reinvested dividends grow your investments faster over time. However, a long-term strategy doesn't mean neglecting your portfolio. Regularly review your investments to ensure they align with your goals, adjusting as needed based on market conditions or personal circumstances. In conclusion, the stock market offers rewarding opportunities when approached with discipline and an informed, long-term mindset. Let's briefly recap the 5 essential tips for successful investing. Firstly, set clear financial goals to guide your investment strategy. Secondly, diversify your portfolio across various sectors and asset classes to manage risk effectively. Thirdly, understand and practice risk management using tools like stop-loss orders. Fourthly, do your research and stay informed about market trends, ensuring your decisions are well-founded. Lastly, invest with a long-term perspective to harness the benefits of compounding and ride out short-term market fluctuations. By following these tips, you'll be better equipped to navigate the stock market's ups and downs. Over time, these practices can help you achieve your financial goals, whether for retirement, wealth building, or financial independence. Please like and subscribe, and best of luck.